Hussey from Zaner Ag Hedge, bringing you a strategy of the day update for August 11th, 2021. We're going to talk, really just focus on the open here that's happening in 4 minutes for soybeans and corn. Obviously, we've had pretty much non even non-existent, if you will, price action in the last couple of days to really talk about. Still very much caught in the ranges, although today soybeans did make a stand and try to break out of trendline resistance. We'll see how that happened and what some of the end results were for the market after, well, effectively failing to break out of that resistance and falling back in the range we were in. December corn failed to break above 560 today. Not a great look, but then again, not much in the way of news has really occurred here to change a lot of the price action we've seen over the last couple of weeks. So remember, trading futures involves risk and is not suitable for all investors, and everything I talk about here today is just my own opinion and not a direct trade recommendation. But with that being said, if you do like what I'm talking about, you want to turn it into some trades, give us a call over here at Zaner. Shoot me an email, find me on Twitter, shoot a message on Facebook. We're here to talk with you about how to turn these ideas into trade plans and marketing strategies for you. Okay, so beginning here with December corn. Actually, let's begin with the December to December spread we were looking at previously while we kind of wait for live price action to come in here after the bell. I've got a 4-hour chart up of the December 21 to December 22 corn. We took a look at this in my last video, had a bit of a trend line here in the short term. That trend line is now gone off of the highs. We moved through it here in the last days of price action. We're trading up to just test broken resistance as now, excuse me, support now as resistance, and we seem to be channeling lower. So again, more important for this chart to get back above the 45 cents over area. That would put us above the lows at 46 cents under from the end of July and take us back to probably a test of the highs for August if we can get there. But this market, again, we talked about how we could be in a period where we're starting to build carry back into the trade and a break below 30, which I've got a hunch that will do something here, whether end up below 30 or trade back up towards 60 here to and through this report that we have coming out tomorrow. So the WASDE report is obviously a big one this year. The August report, if you remember 2 years ago, resulted in what was otherwise a pretty bullish news event that then was unfortunately, sent the market higher and then unfortunately reversed to limit down on the day. Not saying that that is exactly how tomorrow will play out, but I think we can all agree that with the level of consolidation and how tight and coiled up the market has gotten, a quick look at December corn is a great example of this. Futures markets don't sit well or sit still for very long. And this sideways wedge that we have in December corn is going to probably break tomorrow. The inside price action we've had between the highs of the 565 highs for August and the 540 lows, this 25 really is kind of now a 20-cent range that the market has just been ping-ponging in, has got to go. We've got a much larger range, though, between $6.40 and $5, that $1.40 range here. And we are starting a little bit lower on the evening. And this, to me, for December corn, with a very minor gap lower from where we closed. But when you do come down to a 5-minute chart, you can see we do have an open gap here. This open gap will certainly be paying attention to. Anytime I get an open gap on a chart, I immediately throw up a price level indicator just to remind me that it's there and that at some point in the future we could or should come back to this type of level, as gaps are often not left open on charts for very long. In this event, though, if we do leave a small gap like this open, we trade lower, it could all be back on the back of a failure to break out of trendline resistance, which you got a 15-minute chart up here drawn from the highs at 573 through the highs here at 565 and failing today to break above that trend line at 560. To me, just keeps this market in the range until tomorrow. So the gap is not as important to me right now as the failure to break above that trend line resistance was today. Now, the open gap up at 575, however, That is a little bit more important to me because that gap we completely failed on a very healthy attempt at the end of July to come up and fill. Failing to fill that gap, even in the face of weather markets, is one of the reasons that I have been unfortunately favoring the downside. And as bold up as most people are into this report, including commercial interests and our commitment to traders, which got a little bit more bullish here I should say, into this report, it doesn't really bode well if we start to break below certain key levels. We'll take a look here at some of those levels. We'll take a look at beans in just a moment. Don't worry. Flipping over to the December corn daily chart. I want to point out how impressive this market has been to holding here above the 100-day moving average. This green line on the chart coming at 546 quarter is our 100-day moving average. We start to slide below that level, to me, might signal and trigger the selling algorithms, a lot of programs that could, cause this market to kind of roll over and be a technical reason why we're getting sold off. Now, the 55-day moving average has been resistance up until this point. That comes in right around the 559 area. We knew that we had trend line resistance. If you I'll flip back over to our chart here, the 4-hour chart I've got up, but that this dotted yellow line here still holding as resistance. Tried to get above it here today. Not saying it can't tonight or into tomorrow. Just pointing out that we are still in the range that we've been in, and without a solid break above, we can't really talk about going up and trading towards the 578 gap fill, and more importantly, to test this larger trend line resistance and the 580 area altogether. There's a lot more above that. $6 is a psychological threshold, and of course, the cluster of highs that we've had in this market between 611 and 638 that the market has been unable to break above as well. So how could tomorrow play out? Well, we know that the USDA is pegging corn yield at 179.5. Zaner's own analysts think that yield is only going to drop by about a half a point, which is actually on the high side of analyst expectations. So analysts are on average thinking that this thing is going to come down to a 177 area, maybe 177.5. That's a 2-point knockoff of this level. So I think anything above 177.5 is going to be considered bearish against the trade here for price, and very unlikely I think it would be to see a rally in that event. Not saying that we couldn't go higher, it's just everything that the market and that we're seeing and playing out and the fundamentals and weather events not driving premiums into this market, seeing carry built in this market when we look at that December on December spread. And it's not just, where the spread is here today. And yes, we've had a nice 2-day rally in the spread, but we've had an entire month of building carry back into this market. 30 cents, over 30 cents, 40 cents of carry back into this market. If we start to, if the market decides to break below this 30 threshold, build more carry into the market, we're not going to be anticipating December corn, at least December 21 corn, remaining very bullish. Now, how does this chart turn bullish? Well, certainly if the USDA comes out and surprises the trade with a number below 177, I think that would be pretty shocking. We are kind of anticipating them potentially, diminishing some of the export and domestic demand, given that ethanol mandates and other things have changed, unfortunately. But the truth of the matter is that we have a sideways range until it's not here, and all I can do is tell you the levels that we're going to look for to break. So above 560 to the upside, look for that gap fill back towards 580. Above there, back towards 610, and we're still in a range, but we'd at least be carving out the range to the top side. Now, getting above $6 tomorrow, totally and plausible. We went out the day, although I guess it's not, because limit up would put us just shy of $6 with a 558 settlement on the day. That would put a cap on the day at 598. But nevertheless, we could get almost to $6 tomorrow on a limit up move. Obviously, our last limit up move in corn didn't get much follow through and fell apart. So, not saying we'll see a repeat of what we saw in late June, but It's certainly possible. Anything can happen in these markets where there's just a lot of tension and a lot of pent-up energy in sideways price action, right? We've spent months now building stops up here where shorts would cover from. We've built stops down here below 540 where longs would liquidate. And when we take a look at that 100-day moving average, we're reminded how the market could, trigger some of those technical levels very easily here if we start to slide. So more importantly than where is the upside on this chart potential, because, okay, above $5.80, $6, we'll start, we're over a day away from that type of price action being able to happen. So we can't really talk about it, Let me bring back my other chart here. Give me one sec. There we go. We can't really talk about that yet because we can only go 40 cents tomorrow. Now, we have that kind of day. You'll definitely start to hear me talk about the upside potential towards $687 and above, what it's going to look like and how we can get there. However, I think risk is to the downside here. And more importantly, where are some of the supportive levels that seasonally this time of year we usually see a harvest low form? Not, anywhere between this mid-August time frame all the way through October, we have the highest probabilities of finding that harvest low. Well, the open gap at 477, a lot of these levels we've heard a lot. I know I'm a broken record with a lot of them, but hey, it's not me spinning, it's the corn market in a very tight range here. So again, down towards the $5 to 460 area, there's a cluster of supportive areas, trend lines, open gap, and even the 200-day moving average down around 491 that we could go down and find. So again, I think risk is to the downside. I think for producers that were maybe fearful, and here comes some of the marketing strategist hat being put on, and why, your broker isn't giving you this information. I don't know why, but if you have the opportunity, give me a call. I'd love to talk to you about how we can put some of these strategies I'm about to go over to work for you. These aren't direct trade recommendations, but this is the closest I will get to them for many people. Over this last week, I've been recommending buying puts below that 540 area, specifically in the week 3 August timeframe. I like trying to get some protection on as cheap as we can into this report. Now, those are off of the September contract, so September trading very closely to December corn. It's almost a perfect hedge for us, but we have to be aware of that September-December spread as well. If that doesn't float your boat, you've got 16 days until expiration, 15 tomorrow, until the September on December options. They go off at the end of the month of August. They give you not this Friday, but 2 Fridays from now expiration. They'll cost another penny or so more in time value, but in terms of getting a tight protective level above $5 into this report, that if we had a limit down move, you would be praying that you'd had bought these sooner, is definitely, in my opinion, a great way of getting some protection on, particularly for those that have feared doing sales. We didn't know if we'd make a crop. So if you don't have any protection on out there, this is a great way of looking at this. And these are all strategies that my clients are getting every day. Hey, again, not to harp an advertisement here, but if I'm giving this idea to you, why wouldn't you be working with me? With that being said, again, things will, but the 540 to 530 strike is where I'm looking. The reason being is that that's kind of the clusters of lows that we've held since August and late July here, and certainly would be below a break below the trend line support we have formed on this very tiny time frame. But it also gives you at least 35 cents difference down towards and protection down towards for 6 to 10 cents of cost. You can find an option that will give you that protection through either next Friday, not this Friday after the report, but 1 week after or 2 weeks after. You can find a good option for a 6 to 10 cent cost put option that would give you protection a total protection above 520 and 20 cents of potential to the downside on, in my opinion, to the minimum that you'd get if we got a test of $5. Now, we test $5 again. I think this time it would flush through. It would cause that capitulations, the hair on fire. We'd all be panicking. Oh no, we'll never see $5 again. You'll get the emotional roller coaster of wanting to sell down there to just lock in prices before we go any lower. But the truth of the matter is that's the opportunity that if you had puts like the ones I'm talking about on, you could then buy futures against and have a great reownership strategy with a floor of protection as a hedge above. So Not that there's anything to do just yet in putting orders down at those levels to be a buyer, below $5 or whatever. But again, I think you've all would be aware at this point that 460, 480, even just below $5, as we start to get in there, I'm probably going to switch my tune and start looking for some kind of market bottom to be forming. So again, I think there's a good opportunity here, low risk, not necessarily high reward because it is a corn option, but a great way of putting on protection here into a news event where we've coiled up and have a high probability of going one direction or another. And to that point, this coiled up price action, we'll get to beans in a second, and I'll talk about the exact same type of strategies I'm thinking about there. This type of coiling in the market is going to break one way or the other. So if you don't like the idea of putting on downside protection, or maybe you're a cattleman and you're worried that this report could send corn to $6 right now. Well, 570 to 580 calls are very cheap over the same time frame. A way of putting on protection for less than 10 cents here into a volatile event that is pretty likely going to go above 570 or below 540, in my opinion, into this or after and through this report. And it might go both directions for a bit. So we'll see what happens, but in terms of a cheap insurance policy, man, is the market pointing to them right now. Okay, now soybeans, November beans, trading at 13. That's interesting. I wonder, 1336. I wonder why my one program is a little lacking here. But November beans, a really terrible look to price action today, if I have to be completely honest with everybody. I was excited to see us get back up there and fill the gap. Apologies, my chart's going all haywire on me. There we go. Lots of lines. Bear with it for a second. We're going to clean this chart up, and you'll see what I'm seeing. I still see a channel... I wish this would stop jumping around us. There we go. I still see a very clear channel to the downside. We failed to close above today, this channel. We failed to close above the gap fill. We broke through trendline resistance, but man, you can't really say that it closed up there. So I'm going to remove this channel from the chart, even though I still see it there. So you can see the smaller time frame. Let's go down to a 15-minute chart real quick. So you can see the smaller time frame channel that is forming on this chart, and we're really okay. We're into channel support right now, down into 1335. I do not feel and believe that this is a reason to be a buyer down here. I personally think we might go through it to the downside, and I know I'm probably the most hated man on the internet for telling us all that I think tomorrow's report is going to disappoint the trade and we're going to end up going lower. Whether it's not off the report tomorrow, I think over the next few weeks into the Pro Farmer Crop Tour, I do think price will go lower. I do think that will be a buying opportunity as well. We'll see what happens because the fundamentals for beans are still bullish. It is really hard to be bearish beans on the fundamental side, and it's really hard to be bullish beans on the technical side. Right now, I think the technicals are going to win out in the short term, cause the fundamental trade and everybody to scratch their heads and go nuts and crazy when beans are falling. But the truth is we need to attract demand in a real way. Yes, almost 1 million metric tons of soybeans sold over the last week, 929,000 to unknown into China. That is awesome. But I also think that might be some window dressing ahead of this report because, anyone who needs to buy beans would be fearful that if the USDA came out and said 48 or 46 bushels an acre here, which are extreme cuts in my opinion, wow, that would tighten this balance sheet up to basically running out of beans. I think below 47 at this point. I'll have to check my math, but I think, we are so close, right? Think about it this way, right? The 929,000 metric tons of beans that were sold over the last week equates to, I think, 38 million bushels. That equates to 670, maybe 680,000 acres of soybeans. So when you consider that we only need to shave off about 1.8 million acres worth of production to completely run out of beans this year, if we're in that 180 to 200 million bushel carryout range, boy, bringing yield down just a couple points is really going to hit that number hard. So that's why, I'd love to say that the USDA is going to throw this one to the way of the producer, but most of our reports this year have been bullish. And up until recently, those bullish reports got a lot of follow through. It wasn't until basically May through June where we started to see big sell-offs post reports. And this time of year, when we favor sell-offs, with harvest pressure coming in, we favor a harvest low forming. So nevertheless, this very choppy upwards trend is still higher highs and higher lows through today's price action. It failed to break out of that trend line, went up to fill that 1352 gap. We can remove it from the chart. Gaps fill, it's what they do, but boy, didn't we hold that resistance area anyway and fall back down. We failed to break above the 1359 highs for the month of August. We failed to hold above trendline resistance. We failed to hold above the 2 of the prior day's highs, and we fell right back into yesterday's trading range. With follow through today and an early price action, I am very fearful. Is there a small gap on this chart? Let's take a look. Nope, that's a clean open for the beans. There's no gap here to fill with the exception of ones way up above that we've left open now. But we start to break below this 1335 to 1332. You could really use yesterday's low at 1333 3/4 as a good line in the sand. We break through that level, and I'm fearful that we may in fact be starting our trend on our next leg lower, maybe even before this report, which would be a little surprising to me. So, with all that being said, support still around the $13 mark. We can't deny that here. Resistance here in the short term could be up around 1364 to 1380. There's larger trend line up there as well, drawn across our highs. But a bigger breakdown here for the beans. We've talked about here, I think the next real level to look for is between $12 and $11.30. That's 70 cents area. There's trend line, there's a 1231 200-day moving average, and there is, of course, the full 50% retracement from our 826 lows to 1480 highs comes in around 1150. So if you want to attract demand back and get back to the levels that we saw massive export numbers, from that 1050 through $12 mark through September through February of last year, or September of last year, February of this year, where China was buying soybeans hand over fist, boy, oh boy, I think that would attract them back in a real way. And a lot more than, a couple cargo fulls a day here that have added up to 1 million metric tons over the week. That's impressive enough, but we were seeing 1 million metric tons a day at times and some absolutely massive exports back then. So the larger time frame chart here for the soybeans, November beans below their 100-day moving average and have been holding it as resistance. So almost opposite of what the corn's doing with that level, the beans have been holding as resistance. 18-day moving average and the 55-day moving average, you could say that the 1350 area and 1360 area, respectively, they're held as resistance. Boy, this chart is getting really close to looking like it's going to roll over here. We've got trend line support against the lows. Let's flip back over to that 4-hour chart. Trend line support against the lows here. That comes in somewhere around the 1324 area as well. But the lack of real conviction and this very choppy bouncing price action we've had in this channel higher, I am very fearful if we start to go below, we're going to just see the next leg lower to test 13. Below 13, I'm sorry my chart is acting crazy here, but below 13, and we're probably beginning that leg lower. So soybeans, just like I talked about with the corn, you could look for options just a couple weeks out to give you that nice price protection below. Soybeans, you can get that same type of level around $13.20 to $13. Spending 9 cents. I think I was pricing out the 13.20 week 3 August puts on. In terms of a way that you can spend pennies to make dollars in a market with finite risk that you don't have to worry about, what you spent, 9 cents to grab a put on the 13.20 mark. That if we do break down over the next week and we find ourselves $1 lower, you can literally spend 9 cents to make over $1 on, because we only 16 cents out of the money here on the November contract. But again, that short date, that option that I was just talking about for 9 cents, that it may be worth a little different now. is, or would be, it's trading at 1343.75 here in the September futures, is 20 cents out of the market. Why did I go with the 1320 strike here on against in the September? It's just the lows of the market. And by the way, below that low opens the door for a slide of 40 to 50 cents lower. So for a 9-cent cost to have a floor in at 1320 on the September contract, you have a break even down below 1310 or 1311, just below the lows of the month. Below there is all profit for you, all money that you could potentially make with that type of strategy. Actually, why don't we take a look at where some of those options are pricing right now? This is the strategy of the day forecast after all. And then we'll get going for the evening, because that is a whole ton of information to digest. And this, again, you know, there's no guarantee this is going to work. But if you're looking for some form of price protection, or you like the idea of having something aggressive for very little money, weekly options are a great way of doing that. And not enough people talk about them. Yeah, the 6 cents you spent on a 535 corn put, it might be a little bit more now. We're going to find out. So this is the expiration here. That's a week out. You also have the short dated Septembers. Let's look at that for corn real quick. So 535 there. View quotes. There we go. That's all we really care about right now. And I do think I want to put theoretical on this. Okay, that's fine. So there we go. So a 535 put currently for December. This is a short dated September on December. So it's still off the December contract, but it goes off on the September option expiration in 2 weeks from this Friday. 7.5 cents right now. It's bid at 3, offered at 8 3/4, traded at 7.5 cents. Theoretically, it says it's worth, call it 7 3/4 right now would cost you. So to have a 7 3/4 or the 535 a put that is 20 cents below us the market right now, cost you, even if you spent 9 cents on it, let's just say that, you have a break even here at 524, and everything below there would be profit. Definitely obtainable in this type of market volatility that we're seeing, right? I was looking for corn though, spending a little bit less. I had been looking at the 530 to 540 strikes, and there you go, costing 6 1/4 to 5 to 6 cents there for 530, 6.5 to 7.5 for the 535s. 540 puts are going for 8 3/8, 9 1/4 offered. So there's no excuse not to get protection if you want it, particularly protection that is just for this report, right? In 2 weeks' time, you can make another decision. If you go all the way out to, let's just compare to what a full-on December would cost you here. 530 puts in December are costing 25 cents. Not bad having a 505 hard price floor, but that's 55 cents out of the money at this point in time. And by the way, if we're looking for a harvest low to form somewhere between let's call it 480, maybe a little lower, there isn't as much profit potential or protection there as you would like, even though it's a perfectly viable strategy. And it really depends on what you, the producer, how you'd want to protect yourself into this type of volatility event. Okay. The full-on November options, way more expensive here for the soybeans, with 71 days left on them, trading at 13.35 last. So at 13.30, look at this, 50 cents right now for an at the money put. That is pretty darn expensive, even though the skew is slightly towards the calls still. That is just because volatility this today upticked with that move higher, but nevertheless, I mean, you got to go down to, I think, the 1270 to 1250 area to get to areas where I like to spend, on an option. I don't like spending too much. I would almost recommend a put spread if you're going that far. But the truth is that if corn or beans are going to break down hard, let's take a look at what those week 3 August short dateds are. I was looking at a 1320, a little bit more expensive here now. They were 9 cents earlier today, but obviously being down 4 cents here in the after hours. and down off the highs. I mean, they got even cheaper than that. They're probably only 5 or 6 to 8 cents at or near highs of the day today if you were really lucky to have been looking at those. But still, bid at 11, offered at 12, so call it a 12-cent cost here to buy a 1320 put. That's 23 cents out of the money. Now your break even is around 13.10. But again, if we start to break down below 13.10, below $13, we're very likely going down to the low 12. So spending pennies to make dollars is the name of the game. Now, the September on November might be the sweet spot on these options, and let's take a look at why. If you're going to spend 10 cents on those week 3 options, you can get one more week and trade off of the November, which is a much better hedge for all of us producers. The 1320 is going for 17 cents here. The bid and the ask here, if you notice, are very wild and wide. If you were going to come in and trade one of these and want to buy it, make sure you check what that theoretical value is on the option, because you went to market right now and just bought a 1320, which you should absolutely not do. It's the dumbest decision you could ever make, is buying or selling options at market. And that doesn't mean you're not talking to a broker saying, hey, get me filled close to market or what the market would be on these. I mean, if you literally just put in a market order to buy the 1320 short dated call right now in the soybeans, you'd pay 66 and 7/8 cents for it, which is just crazy. But as price action settles up here tonight, market makers and their algos will start to fill these bids and offers in, and they'll come in tighter. So make sure you know and can calculate out what that theoretical value would be, because if you put an order out there at 17 or 18 cents for the 1320s, there's a very good chance you would get a fill, or a little bit of market movement might entice somebody to come in and fill you on that price. So be very careful when looking and trading these options, because right now in the the overnight session, and certainly in the first part of that session, it can be very expensive by making mistakes like that. But that's where, that's why I'm here talking about these things with you as much as we can. So again, spending 13 cents potentially to get a 1310 put, not a bad idea. You basically are, that's basically puts a floor at about $13. And again, you're not laying out too much risk here, because a 60-cent move, 70-cent move lower, in beans is totally plausible on a news day tomorrow, which would put that option in the money by then 30 cents. So again, looking for ways to spend pennies to make dollars in a high probability type of event, where the market could move a lot. Okay, like I said, the call side is equally attractive if you're looking for upside in these types of markets. I mean, 1380 calls, look, they're a little further out of the money. You're almost 40 cents out of the money, or just over, almost 50 cents of the money, and you got to shell out almost 12 cents there to buy that 1380 call. But 1380s to the upside is not out of the question either if this market wants to go and move higher as well. So again, spend pennies to make dollars. Buy vol when it's cheap. These are things that you'll read about in good risk management, good trading techniques that lots of traders use for long-term success. It's not always about being right. It's not about how much you make. It's about how much you don't lose. And when you're looking at options, it's about spending as little as you can to get the protection or the type of directional play you want. And that's what I'm trying to highlight here today, is that there are more than one ways to skin a cat sometimes. And these options, particularly the weeklies and the short dated, take a lot of time value out of the equation, meaning you don't have to spend a lot to get the same level of protection. Now, you don't get the protection for as long or through the whole life of something, but I'm fairly certain over the next 2 to 3 weeks, these options are going to do a very good job of giving you the protection you need when volatility starts to spike. Then it's going to give you the ability to make a choice of whether or not to hold on to the profits in these options, roll them into something more expensive, longer dated, other types of protection if you feel like you need it through the rest of the harvest season. They can also parlay into a you can jump it into and roll it into a strategy where you're buying futures. Imagine a world where, or selling futures. Imagine a world where you're long that weekly call or long that weekly put. The market goes in your favor, and now you can use a future to offset that strategy in the meantime. And of course, you could always then just lift the option as well for profits if it works out for you. And the best part is, if you're dead wrong, you know exactly how much you lost in today. The options we talk about talked about were all well under 15 cents, which is very reasonable for a lot of price protection into tomorrow's event. So with all that being said, everybody, have a great day. Have a great rest of your evening, I should say. We'll be back with you tomorrow to discuss more with the report. Be sure to sign up in the links below for our webinar we'll be hosting with the Zaner team to break down and recap what the WASD webinar or WASD report will come out and say. We'll give you our best interpretation of the numbers and what's gone on. Certainly try to recap how some of these options we talked about here today may have fared out and played out, and would always love the opportunity to discuss them more with you in detail. And hey, become your broker. If I'm giving you these ideas, you better believe there's more of them behind it. 312-277-0110. You can find me on Twitter, Facebook. Follow me at SOTD to get all of these videos and more. Shoot me an email at dhussey@zaner.com. Have a great night, everybody, and we'll be back with you tomorrow and as price action develops. Take care, everyone.